No, and we would say it would be a mistake to try to market time the diversification benefits of bonds. Investors were worried last year about rising interest rates, and if they forgot that principle, they lost out and didn't have the hedge against risk assets. It's been a fabulous year for the bond market, and there still is value when you're looking to hedge against credit and equity risks in a portfolio. So we would say no to that, and we would expect that interest rates globally will stay low for at least the next 3 to 5 years, if not beyond, because of some very powerful influences.
So, Tony Crescenzi, what is the forecast on the amount of Fed rate cuts this year and how big they will be?
Well, there are a lot of different outcomes. You'd expect me potentially to say that. And when we think of where interest rates are, call it between 1 3/4 and 2 for most treasuries out to 10 years, one might say that's roughly fair value for the insurance variety of rate cuts, which is the most likely scenario now, our base case, that the rate cuts that come will not be the resuscitory type that are needed to prevent a recession or to address a recession, but to simply let the Fed engage in opportunistic reflation to enable it to take advantage of strength, if you will, in the economy relative to growth potential, strength in financial conditions to pull up inflation expectations because it's been so difficult to do so. And so this will probably keep yields in the zone. One final point. One factor that influences yields tremendously is the fact that in a couple of weeks, the U.S. expansion reaches its longest ever, 11th year, dating back to 1854. This means investors will constantly be looking around the corner at the potential for a recession, constantly assigning some risk that the Fed returns its policy rate back to zero, where Treasury yields could collapse towards zero on a commitment to keeping rates low for some time.
Tony Dwyer, who's with us here at Post 9, what's your take on what the low yields mean for equity markets?
So, Wolf, I think it's a really important point. So the market's basically with the 10-year trading below the lower bound of what the new Fed funds target would be if they actually lowered rates. The 2-year and the 5-year trading below another 25 basis points, basically 50 basis points. And I agree with Tony that it's an insurance cut, not necessarily for an economic catastrophe or some kind of event like long-term capital management. Here's what, in the bond market, when we come on here and we say the bond market's telling us something, it is really important to define which bond market. The Treasury bond market is telling you there's no inflation versus there's a coming recession. And how do we know that? Because every other area of credit's doing very well. Investment grade credit made a new high on its main ETF, the LQD, today. So you can't say that agency credit, mortgage credit, corporate stress in any Fed measurement is doing poorly. They're at their best cycle levels of the cycle.
So what's the upshot? How much more juice can we get from this equity move?
I think we can get a lot into next year. I think we're going to go to 33.50. Your average multiple when the core inflation rate is between 1 and 3% is 19 times. It traded there between 2016 and 2018. I don't even have to make up for past cycles. That happened recently. So our target is based on next year's numbers. But think about this. Money is still available as seen by all other areas of credit. You got a 100 basis point drop at least in mortgage rates because of the way that the Treasury market's moved. The slowdown in economic activity is the bull story. We keep portraying it like that's the negative. That's the bull story. The worst thing that can happen is you get aggressive growth, the Fed doesn't cut rates, and all of a sudden you got a problem in credit.